Good morning. This is Jim Barlow with OakTree Strategic Leverage. Sometimes you have some issues moving around the computer to get the right screens up. Oh well, here we are. Welcome to my major. Let me get my. I'm still having some issues with my screen, but we'll get it going. All right. Okay, I got it. All right. Okay, here we go. Inversion thinking and Kaizen. This is my flagship presentation, thinking about eliminating failure before we pursue growth. I think this is vital for almost everybody. Um, and I'm going to show you how Kaizen answers that question. Anyway, inversion thinking. The hidden problem, just like an iceberg. See the big part of it underneath the water. What derails outcomes isn't what people see, like the Titanic, is what they don't see. 35 years in the investment business, I made mistakes because things I didn't see. So who am I? A lot of you know, but good review. I'm Jim Barlow, lived in Clearfield most of my life. Barbara is my wife. We're blessed with 7 children, 28 grandchildren, graduated from BYU. We're devoted fans. I don't know if we're rabid, but I've spent about 40 years as an investment advisor. Today, I lead OakTree Strategic Leverage. It's my legacy business. I'm sharing wisdom, helping others, and staying sharp. We have passions. We love to travel. We read, we attend plays, we treasure family time with our family. We serve in the temple, striving to be disciples of Jesus Christ. And the reason why I'm doing this business, I want to help people have a better future. So, inversion thinking. Most people ask, how do I succeed? How do I do it? Inversion asks, what would cause me to fail? Avoiding ruin matters more than chasing upside. Eliminating what destroys progress, and progress compounds. Wow. Charlie Munger, on inversion thinking, he's one of the cool, he's deceased now, but he said, tell me where I'm going to die so I won't go there. This is his funky way to introduce inversion thinking. Don't do what is going to hurt you. He said it better. Avoiding stupidity is easier than seeking brilliance. Don't make mistakes. Don't focus on how to win. Focus on how not to lose. Inversion thinking. I've reversed my tree and I put an arrow as we spin it around and we look at the roots and we decide what's going on here. So inversion thinking is solving the problem backwards or upside down. Maybe I should have put upside down. Instead of asking, how do we win? How do we avoid losing? We don't ask how to win first. We ask how to avoid losing. And there's the upside down tree again. People fail at investing. Early losses and sequence risk. In retirement, this is a big deal. If you're pulling out 5%, whatever you're pulling out per year, if it's an account that just went down 30%, you're devastated. This is how people fail. Sequence risk. Another one is loss of timing control, where you have no control on things as the market makes changes. Unprotected leverage. Wow. People lost homes in the real estate market of 2008. Emotional decisions. I keep wondering if I should put that first. Uh, I had some clients that were so emotional, they just could not be an investor with their fears. Taxes. It's there. How do you avoid taxes? Inflation, always there, always there. We're living in a fiat money world. It's not going to go away. It's always going to change. One of my grandsons is buying a house, and my wife was telling me it's about $500,000 for this starter house. It wasn't for me, and for you, probably. Anyway, so if we could remove these failure points, if there's ways people, if these are the ways people fail, then what would a strategy look like if we're designed to remove these areas of failure? A better design philosophy. Before we talk about growth, we eliminate the reasons plans fail. This is inversion applied to wealth. In football, you'll recognize this. Don't ask how to win, ask how teams lose. Most football games are lost because turnovers, missed assignments, penalties at critical moments, poor statistical decisions, situational decisions. Championship teams don't win by being aggressive, they win by being mistake proof. And just this last season, there's lots of games like this. Version thinking and being good at not losing. So enter Kaizen. Kaizen is an inversion strategy. We remove the chance of loss, of timing risk, tax uncertainty through a structure, not from speculating in the market, and then letting disciplined leverage, because we don't have these losses, do what it does best. Kaizen was built backwards, designed to prevent failure first. Growth at the reward, not the starting point. Here's 5 bullet points. If I was doing a quick napkin presentation at lunchtime, we remove the loss. There's no downside. We eliminate tax erosion. We don't have personal risk with the leverage. We have a structure that works, and liquidity when it matters, as my punchline or tagline. Smarter leverage, greater outcomes. I did this chart a while ago and I just couldn't get rid of it because it's kind of fun. Kaizen removes failure by design, no negative market years, no current tax drag, no outside collateral, no personal guarantees, no forced liquidations, no required minimum distribution pressures, no margin calls. Is there another one? Growth comes second after risk is engineered out. Gotta keep the slide. So what outcomes is Kaizen good for? This is dynamite for a supplemental retirement income in addition to your 401k. Whatever else you have set aside, this is a diversification that's essential from this taxable account to something different. Supplemental retirement income is also really good for just income tax planning or reducing taxes. Family gifting, it is the number 2 reason people buy Kaizen. Executive employee retention, a solid one. or we did a webinar last week on this, where we'll be repeating it every two months. Business succession. We've got one coming up this month. I've got it ready. And just charitable gifting. There's a lot of uses. It's the same policy. Oh, I forgot that one. Creditor awareness. It is protecting your assets from creditors. So the next 3 slides is kind of the slides I've had in every presentation I've been giving about the details of Kaizen. Even with these next 3 slides, we don't cover everything, but I've put it into 3 categories: the foundation, the risk elimination, the growth, and then the control, the structural control. Let's get started. Removing the risk that breaks financial plans. First, it's a life insurance policy. Day one, you have life insurance benefits. And with time, it'll be like getting the life insurance free because of the growth and the way this has been built. And in addition to those life insurance benefits, you've got these living benefits. You've got disability benefits. Day one. So you've got the disability for sickness or injury, and you have long-term care benefits. It's a protection package all in one. So there's the foundation, the beginning of the foundation. Second, tax-free growth and access. I put grows tax-free. I could say grows tax-deferred, and you can use it tax-free. When life insurance, when life insurance is paid out to the beneficiary, it's tax-free. That's by law. And it has been since 1913 when we started having income taxes. And it's growing tax-deferred, and you can borrow from it without paying taxes. This is how we create a retirement income strategy tax-free. I'll show you some numbers of how it's performing in a bit. Tax-free. Next, this is a life insurance policy. There's no advisory fees. I charge 1% in my business. There's no management fees. It's not have a mutual fund with internal fees. You have lower costs in those areas. I probably should put an asterisk and say you still pay insurance fees, but over time, we overcome all of those. This is the foundation. Life insurance, tax-free fees. Next, the growth. You could actually say this is the foundation and protection. There is no market downturns, no market losses. The worst performance you can have in any given year is 0. When the market's down, whatever, 2008, it was down 37%. It had been down 0. No downside protection. And with that, you get market-linked growth. Maybe I should spend more time on this on webinars. Maybe I'll add a little bit more there. You get upside participation with that no downside risk. I want to show you how this takes place, how come it happens. The majority of your premium that's beyond the insurance cost is going into the insurance company's general account, which is all high-grade bonds, U.S. government bonds and high-grade bonds. Only a small part is going to an option budget. So $1,000 beyond the insurance cost, in a 5% interest market, $952 would go into the general account, which in a year would grow back to $1,000. and we have $48 to buy options to replicate market returns. No downside, but market-linked performance. It works really good. I'll show you numbers again. So that's the second part. Then the third, this is where Kaizen started tweaking a few things to make sure it happens. It's a 5-year pay, 5 annual payments with Allianz. We can actually do a monthly payments for 5 years. Finite, predictable contributions. You know what you're paying for how long, and it's not forever. 5 years. Trust ownership. We set up a trust for you to be the owner of your policy, and we have a master trust where the master trust does the leverage, which we're going to get to. And it also offers protection from creditors. This master trust who's doing all the I'll call the legwork. Strategic leverage. We only do 3-to-1 leverage, not 20-to-1. 20-to-1 could break a situation, and I'll show you more about that. But strategic, very controlled and minimal. Because of there's no downside, and you don't have to do much of anything. It's a turnkey design. You can just stay with it in your original investments. You can make changes once a year, but in most cases, you just don't need to. And last, liquidity and flexibility. There's not the liquidity and flexibility, or the liquidity in the first 15 years, but there is tons of it afterwards. That's kind of a two-edged sword, but important to understand. That is all the major bullet points. You probably have questions, write them down, happy to answer, try to help you. Here's a diagram showing the payments. The silver pigs are your payments, the 5 annual payments. And the bank that we get involved is doing approximately the same amount in the first 5 years. Then in the next 5 years, they're taking on what you're paying and still what they're paying. It becomes about a 3-to-1. So that's the leverage that we go with. All this leverage without the typical risk of borrowing. There's no credit checks. There's no loan documents. There's no personal guarantees. There's no signature. There's no collateral. The master trust system and the way we tweak this policy allows this to be done with no risk of borrowing. Here's a little bit example of that master trust. The milk bottles in the bottom is your trust, your personal trust. And we have a bunch of them. We have launches every year of a bunch of policies that go into the master trust, and the master trust is the third party management that does the borrowing and takes care of the management. Really essential and helpful. One of the biggest tools we have is some software called ILIA. You can't hardly read it in the upper left corner, but Interactive Learning Information Assistant. And you can have access to this by getting a login and a password. But here, this is one I use almost daily. And it's very robust, and it has chapters, a lot of information, but it has a has to estimate my benefits, and that's what at this point I want to show you a sample. Here's our hypothetical insured. We're going with a 46-year-old male, excellent health, putting in $70,000 per year for 5 years. And he wants to start receiving a distribution at a normal retirement age of 65, and he wants to make sure it continues through 90. That's our basics. There's an entity called the NAIC, National Association of Insurance Commissioners. They regulate at what rate you can illustrate, like we're going to do, entities. This is the 6.81 was the illustration rate permitted on January 24th. It hasn't changed. So it still is. Whenever that changes, I change all my numbers. But we're also, in this illustration, I'm going to show a long-term capital gain rate of 20%, income tax rate of 37, and assumed asset management fee of 0.5. Let's get started with this. Oh, I forgot to tell you. The reason I chose 46 and 70,000 is the average buyer of Kaizen nationwide is 46. And the average contribution is 70,000 per year. I don't actually know if it's male or female, but I'll assume it's male. But so this is the average investor of Kaizen nationwide. Okay, we want to compare and give you some feel. So if we get 6.81 from an account that we set, an investment account, put 70,000 in for 5 years, this account starting at age 65 could give this a person 58,642 per year, starting at 65, and through 90, he'd have pulled out $1,524,000. I wanted to give, for comparison, as much income possible, so it's still earning 6.81, but I've used every penny. 91, there's no income. This software I use, I could have put 95, I could have put 100, I could put 60, anything, but 90 is, I think, a good age for this illustration. But I've used every penny to give this as much income as I can, 58,642. Another option would be a tax deferred account. This is your IRA, your 401k, and wow, it works. This person would get 74,106, and same 6.81% return. Just the tax deferral help them have more income in retirement and more total income through 90. Now, drum roll, please. The next line is going to be Kaizen. Drum roll. Is it going to be higher than 74? We're still using the 6.81. Is it going to be 84? 94? Oh, it couldn't be over 100, could it? Drum roll, please. 130. This strategy makes up for all the insurance costs with having no downside and the no fees and the other things we've done to tweak it. 130,000. And guess what? That's tax-free. So through 90, age 90, it's 3,380,000, and shoot, there's a life insurance when he started at 45, 2 million, and there's still life insurance at age 90 and 1,700,000, and there's still cash value earning. This person could continue to have 130, probably through 100 or longer. So Kaizen performs at the same return, higher income. Wow. Now let's see. Okay, Jim, what if times are bad? Sometimes I think they are. Well, if we've stress tested Kaizen in bad times, the first one we stress tested in the 1980s, high rate environment, loans got as high as 16.88%. Remember, so you younger kids don't, but I remember the 1980s. And so we've simulated historical loan rates and high interest rates into Kaizen, and we're going to show you the results. But there's also another stress test we did. We did the Great Depression, 29 to 32. The worst sequence of returns in US history. From 29 to 32, the market was down 86%. So what we did, we simulated 9 years of zero over 12 years. Notice zero, we didn't have a negative year, just 9 years of zero. Wow. So, well, we wouldn't be showing it passes the test. Let's show you. First, the stress test in the 1980s, it'd have been 97,500, not the 130. That's lower. Boy, but the 97 is beating the tax deferral, is beating the after tax substantially. So even if we have terrible interest rates, this is the best place to be. Well, what about that Great Depression? It is lower, 84,500, but shoot, the 84,000 is higher, 10,000 over the tax deferred, and we didn't show what the tax deferred lowest could be, or the tax deferred after tax. We just showed the average, like the 130 or the 6.81 all the way through. So they would be hurting too. We do that on all policies. We're always stress testing this. And I'll show you another stress test we do in a bit. Drum roll, please. What could I do with another drum roll, please? Well, Allianz said, we want to analyze this illustration software you have. We want to make sure, since you're a partner in business with us, that you're giving the truth, that these numbers are not fudged. They studied the ILIA illustration system, and they came back and said there's an 80% chance, that, ready for the drum roll, 80% chance that it will be double. Not 130,000, it'll be 260,000. 80% chance. So here we go. There we are. 84,000 on the bottom, 130 with that 6.81, 260 at 80% chance, 6 million income total through 90. Wow. This is a powerful tool for retirement and those other uses. Okay. Ooh, see that little, I really had fun making that. I just a one pager here, but what if this person is female? 46 female, not male. Well, the Kaizen, instead of 130, is 133. Let me just back up. Oh, yeah, if you back up, the bird backs up. So see the 130. So if you're female, you're going to get a little higher return. Not grundles, but better insurability. Now I did something else, and they did a paper airplane for this one. Well, what if this 46-year-old male is just average health, not that excellent health, the Jim, that you're pushing? Well, it is lower. The cost of insurance went up, and instead of 130, he's getting 120. And there's the numbers for the stress testing. So even if you're average health, it still knocks the socks off the competition. You do have to be insurable. You probably understood that, but you do have to be insurable. Average health or excellent health. So even that, those work. All right. The very first policy issued was in 2012. One of the owners of NIW, the designers, the founders of Kaizen, and a partner of mine in the business. The very first policy issued in 2012, and her purchase date was June 27th, in 2012. But you get an annual statement, and the June 27th statement of last year, her average return from day one has been 7.85%. Not bad. And she's paid interest on the borrowing of 3.95 on an average. So that creates a spread. 7.85 subtract 3.95, 3.9 on the borrowed money, the 3/4 of the amount. She's making 3.9% on borrowed money from day one, and where she made 7.85 on her money. Pretty cool. So is that 7.85 good? The long-term historical SP 500 average is right around 10%. Well, Jim, 7.85 is less. Okay. I'm probably okay with that because of the lower risk and no downside. But we haven't considered everything here. Oh, I should probably put a color code. What I added was tax advantaged. The 10% is the return before taxes. The 7.85 will be tax-free. And if we went with a 25% income taxes, so we retain 75, that'd be 7.5. More volatility, no volatility, about the same returns after tax. Not bad. And we did one more back testing. We back tested back to the 1930s, and there has never been a 15-year period of time with less than a 2% spread, meaning we're going to make money on that borrowed money, probably. Well, I'm pretty sure in our policy. She made 3.9, but there's never been a 15-year period of time with less than 2. Got a little excited about using changing of the slides. We got 2 additional landing pages other than the Ilya that I showed you. This one has chapters, it has videos. You can self-learn Kaizen in your free time. There's a QR code to go to this. This was built with my partner of the founders of Kaizen. This is my landing page for me. And so if you have questions, you can type in a question and I answer it. But there's a QR code. You don't need to have, you don't have to give me your email or your birthday or your anything to use this and study Kaizen, all on your own. And I have a second one. Wow, look at that. The second is a QR code with a similar landing page, but is with a focus of using Kaizen as a gift, gifting to your kids or your grandkids. This is the second highest use of Kaizen. The number 1 is retirement, and this is the number 2. So we build a landing page especially for this. and he'll help you in that direction. Again, you don't have to give any information. You can just use it on your own. And we also have the ILIA that I use daily, as I told you, to do my calculations. And this in here, you do need to have a login to get a login. You can, if you send me your email address and your, and I think it's email, well, your email address, name, and I think just your cell phone number. Yeah, that's it. Should probably put it down there. I also have on my website, I have a lot of quick links so you can go to. I'm always working to improve my website, and I think it's getting better and better. One thing on my website that I have, I built a retirement income gap calculator. I've got two versions, the basic and more advanced. These are fun and easy to work. This basic is so you don't need to go get any paperwork out of your files. You could probably do this just in minutes. So on my website, you can use it free. Just go to the website and use it. And go to the advanced one too. But I worked hard to make sure they're correct. So there's really two ways to implement or to engage with Kaizen, and that is through that QR code and go to those sites and study and learn about it on your own. Call it digital engagement. But if you have questions, you can text me, you can email me, you can call me. There's even a chat thing on those landing pages. Anyway, if that's the way you want to do it, that's great, perfectly fine. Or if you want to go to lunch, I'd be happy to take you to lunch. We can talk about how Kaizen works, and you can ask all those private questions and everything. Either way works. It's the same strategy, just different engagement styles. I'm trying to accommodate the different attitudes and approaches people have today. These are my series of webinars that I've been doing and building. And so today is that first one, the Inversion, Thinking, and Kaizen. It's kind of the main one. That's today. Next week we got one on retirement income we've done before, and the next one is family gifting, and we did this last month executive employee benefit, and this coming month we're doing this business succession. Those last three I haven't built yet, but now that I've got all these 5 built, I'll be working on those. Just a little more specific, a little more nitty gritty on those narrow topics. This month of March, the next webinar is March 12th. There's the link to this site. You can take a screenshot, and it's on retirement. Then the March 19th is on family gifting. And then the March 26th is the brand new one on business succession. And then April 1st, we start this one, the flagship again. Did I give everyone enough time to get a screenshot for those who want to? Though also the links will also be on my LinkedIn account. So, Kairos Aurelius, here's some maxims. The first act of wealth is not growth, is the discipline removal of failure. Kairos spoke Latin, and he also spoke Arabic. So I put them in there, and fun quote. Another Kairos Aurelius quote, What endures is not what promises the most, what endures is what fails the least. And me, after 35 years in this business, I've learned to separate products from structures. Most financial tools are structures. Most financial tools are a product, a stock, a bond. Fewer structures. And, well, anyway, when someone has the runway, the time, the health to qualify, I've yet to see a more efficient long-term structure than Kaizen. The reason I'm doing this as a retirement hobby is because it will help people. It will make their lives better. It's efficient. Anyway, we'll be posting this webinar on I replaced the old one. There's one on the inversion thinking. This one we're doing today on my website right now, one I did last month. But we'll replace that with this one today. There's the QR code for that first landing page. There's my phone number and my email and my website. And I appreciate everyone who's attended. I hope it's been helpful. And I'll be looking at the questions that you have and trying to answer them. Let's see. Oh, darn. I've got to be a little faster. I want to try to keep this to a half hour. But with that, have a great day, and we'll see you next week if you come to the webinar. Bye.